once prices go up and up and up, traders leave the market because they can't afford the margin requirements, and that hurts liquidity and makes price swings a lot more dramatic, which is what is going to happen in the gold and silver futures markets as well. So you'll have to be able to hold through that as it's happening. Liquidity will diminish, open interest will fall, prices will go way up, and then they might go way down, but not as much down as they went up, and then way up the next day, and then way down again, etc., until we finally do reach that 15-to-1 ratio, gold to silver ratio, that will signify the end game, the end of the monetary system, the end of the dollar, and the restarting of the economic system.
On today's news recap, silver prices stabilized after economic data showed signs of persistent inflation. Silver prices edged up by 0.23% amid a backdrop of rising U.S. Treasury yields fueled by lingering concerns over persistent inflation. The latest economic data indicated a slowdown in U.S. economic growth for the first quarter, but an uptick in inflationary pressures suggested that the Federal Reserve might delay interest rate cuts until September. Despite the tempered economic growth, positive indicators in the labor market were observed, signaling continued strength in the employment sector. Looking ahead, the Silver Institute Industry Association forecasts a 17% increase in the global silver deficit to 215.3 million troy ounces in 2024. Silver's diverse applications in jewelry, electronics, electric vehicles, solar panels, and investment purposes underpin its sustained demand amidst a structural market deficit entering its fourth consecutive year. Now, we'll show you the best excerpts of Rafi Farber's take on the relevant news, but first, like, subscribe, and turn on notifications so you do not miss out our daily videos. Enjoy the episode.
I'm going to start with the yen because that's where the action is. And if you've been following the silver report for the last few months or even the last few years, you know that I look at the yen very carefully because the yen is basically the poster child for Keynesian gobbledygook magic, proving, quote unquote, that it works, except it's going to collapse spectacularly because it's such a spectacular Frankenstein Keynesian money printing experiment that it is going to crash and burn. I don't know for sure if that crash and burn is happening already, but it looks like it might be. So we have here the final support for the yen at 158.9, I think that is over here. Let's just say 160 in 1990. This is back when the Japanese stock market was at all-time highs. Even in gold terms, it was at all-time highs. And though nominally the Japanese stock market has broken those all-time highs, it is nowhere near the all-time highs in gold prices in terms of gold. So in terms of real money, the Japanese stock market is way down, and this is all an inflationary illusion. It doesn't exist. So we have here the two lines from the stock charts chart over here. We have Japanese rates and the yen, and I've shown this before. I just want to show you in different time periods here. It's pretty much been this way since just after Abenomics began, when he started expanding the balance sheet in an insane way, and the crazy Keynesian experiment became a super insane crazy Keynesian experiment. And since then, we've had higher rates equals lower yen, lower rates equals higher yen. You'll see on the next slide here that the mainstream media still doesn't understand this, even though this correlation has been in place since about 2015. So we go to the next chart here, and this is from Trading Economics. If you look up the yen, this is old already. It says 154.75. We're already past 156 now. So we're very, very close to that final support of about 158 to 160. And we could be there, in the next 2 or 3 days, judging by how fast the yen is collapsing right now. So the point is, if you read this paragraph over here, I'm not going to read the whole thing. Just the first sentence is enough to show you what I mean here. The Japanese yen, it says, weakened to around 156 per dollar, hitting that level for the first time since May 1990, as the Bank of Japan held interest rates steady, despite pressure from a sharply falling currency, as widely expected. That sentence is implying that had the Bank of Japan raised rates, that the yen would be doing better. But we see from the previous chart here that that is not true, and it won't be true going forward either. When will they let go of this fantasy that higher rates means a stronger currency? Because in this environment, when currencies are almost entirely backed by debt, that is not true. So I believe that once the Bank of Japan panics and raises rates in an effort to save their currency and the yen gets even worse, that is when they'll start to have to admit that this is not working anymore and there's nothing that they can do. Going back to this chart, I titled it Yen Carry Trade Forces Yield Japanese Yen Correlation. If you imagine what the yen carry trade is, it takes advantage of the difference in interest rates between the yen debt, and dollar debt, meaning yen, Japanese government bonds, and treasuries. The yield on Japanese government bonds is basically 0 at 3 months, and the yield on dollars is like what? Close to 5% now, something like that. So you sell yen to buy dollars to earn the difference. And the lower the yen goes, you can take those dollars and buy back even more yen. So the more the yen falls, the more that encourages the carry trade. And that piles more people into the carry trade to sell yen to make it even weaker so that they can get even more yen back when they close the trade. And this creates a snowball effect, which is what is happening. So the weaker the yen goes, the more people are encouraged to participate in the carry trade and make the yen even weaker. And I don't know if it can stop itself at this point.
Now Rafi talks about the relationship between copper and CPI, as usually copper leads the market with a lead-lag relationship. Copper, often referred to as Dr. Copper, is a leading economic indicator due to its extensive use across various industries, from construction to electronics. The price of copper can provide early signals of economic shifts, with rising prices often indicating increased industrial activity and economic growth, while falling prices might suggest a slowdown or impending recession. This lead-lag relationship with the broader market makes copper a valuable tool for investors seeking to anticipate market trends. A rise in copper prices can be seen as a signal for a healthy economy and may encourage investment in the stock market. However, it's important to consider other factors like interest rates, global events, and supply chain disruptions, which could also impact market movements. Thus, while copper serves as a reliable barometer for economic health, it should be used in conjunction with other indicators for a comprehensive market analysis. Like and subscribe if you find this video valuable. Make sure you check our pinned comment if you're looking to add crypto to your commodities portfolio. And let's get back into the episode.
Now, I wanted to go into copper prices a bit because historically copper leads CPI quite tightly. Gold also leads CPI, but a little bit more loosely. So if we look at copper here, we see that copper is on its way up again. Copper here is in blue and the CPI is in red. So we see here that copper prices are headed up again, and the CPI follows it. A higher copper price predicts a higher CPI. We're already in a second wave of inflation, and copper is just another way to see that. Now, I just wanted to give a different perspective on cocoa. We've all seen what's been happening in cocoa, something between $10,000 and $11,000 per ton. And this is so-called all-time record high, except it's not even close to an all-time record high. It's not really even much of a move at all. Most of the problem is in the dollar itself, in which cocoa is priced. And here is the proof. You see here on the top, the black line is the dollar cocoa price. And yes, it looks like it's gone vertical here. This is a classic parabola. Yeah, true. But cocoa priced in ounces of gold, where is the all-time high? Well, that would be here in 1973 at 32 ounces of gold per ton of cocoa, which equals about $74,560 per ton of cocoa Now, where are we now? Where are we now? Oh, we have this tiny little cute little parabola here going from about 1.8 maybe ounces to now 4.96. So let's say 5 ounces. So yeah, it's gone up. There are issues with the cocoa supply. I'm not denying that. But most of the problem is in the dollar. It's not in the cocoa supply. Because if people stack real money instead of dollars in their bank accounts, they'd be able to afford cocoa no problem. The price of cocoa is lower than it was in the early 2000s. It's lower than it was around the Asian financial crisis in 1998. It's lower than it was in the mid 1980s, and it's much lower than it was in the late 1970s. And even throughout the entire decade of the 1970s, cocoa was much, much more expensive than it is now. And here's cocoa versus silver. We see the same little parabola, yeah, and it's gotten a little bit more expensive, not denying that, but it's nowhere near the record high that it was in silver terms at about 1,030 ounces of silver per ton of cocoa in 1977, 78, it looks like. Now, I wanted to show two more things. This article from Ahead of the Herd, which usually has pretty good pieces, but this one by Richard Mills is pretty rambling and I'm not a big fan of it, and I wanted to explain briefly why. He says here is a Volcker-like series of rate hikes in the cards by Richard Mills, and he gives this whole rambling historical lesson about Miller, is that his name, the Fed chair before Volcker, and versus Volcker, who hiked rates, and Miller, who didn't, and he goes into the whole thing to show how much he knows about the history of different Fed chairs or Fed chairmen back then, because back then gender language wasn't illegal. Entire article, and I didn't read the whole thing because I couldn't. I just looked at the conclusion, and that is this. And it shows you the same lack of understanding that higher rates are going to lead to higher prices. He says here, our conclusion is that we are in uncharted territory. Everything, including gold, copper, the dollar, interest rates, and inflation is going up. It's a trend for which there appears to be no historical precedent, apart from the fact that the higher interest rates, though painful, eventually lead to the desired result of bringing inflation back into line. This is from Bloomberg, and it says here, cocoa price swings are the craziest since the 1970s. And this is important because it shows you what could potentially happen and what will probably happen in the gold and silver markets leading up to the crack up boom, which I believe at this point is only a matter of months away. So it says here in Bloomberg, cocoa resumed gains in New York with prices the most volatile in almost 5 decades amid uncertainty over a historic crunch and as traders pull out of the market. This is the key paragraph that I want people to understand. Futures have soared about 160% already this year as poor West African harvests leave the world desperately short of beans, but the rally has made it more expensive to maintain positions, prompting investors to close out trades, draining liquidity and making the market more vulnerable to large price.
Will Dr. Copper forecast a decline in the markets and a surge in precious metals? Are you stacking more gold and silver at these prices? Share your insights down below and watch this video right here because it's a perfect fit for you. I see you on the other side.